Welcome to the CRE Syndicate Show, sponsored by PREIshare and Family Office Insights, where we'll discuss passive investing and syndicated real estate with industry leaders and special guests. Welcome to the CRE Syndicate Show, sponsored by PREIshare and Family Office Insights, where we discuss passive investing and syndicated real estate with industry leaders and special guests. Today, we'll receive top recommendations to family office groups from well-rounded expert DJ Van Keuren. We'll also talk about why real estate is such an important component to wealth. I'm Julie Tallman. I'm with PREIshare, and I'm joined by Christian Sadler, who is PREIshare's VP of Investor Relations. Also joined by Arthur Bavelis, founder of Family Office Insights. And I want to give a little bit of background on our guest today before we get started. And he's got a very hearty bio. So hang in there for us for just a second, DJ, before you get to say hello. But DJ Van Keuren, he is currently a co-managing member of Evergreen Property Partners, a family office real estate consortium. He was named as one of Family Capital's top 10 U.S. family office real estate professionals, and as one of the Trusted Insights top 30 real estate investors at a family office, and is currently the president of the Harvard Real Estate Alumni Organization. He's had 25 years as the managing director of the American Dream Fund, a fund that was positioned to be the first single-family REIT. It's been responsible for over $5 billion in real estate assets. He is a member of the Forbes Real Estate Council. He's author of Real Estate Investing for Family Offices. And lastly, I told you it was really long, he got his master's degree from Harvard University in management. So not only is he super experienced in family office business, but also real estate in general as well. So welcome, DJ. We're excited to get your take on the market.
Thank you, Julie. Glad to be here.
Thank you.
Well, and let's jump right into the shakeup, if we will, because we're seeing a lot right now in commercial real estate. They're saying that foreclosures have jumped about 137% as opposed to last year. We're also seeing that many of the crowd-raising platforms that were out there have all but shut down, and those that are still on are seeming like holding on by a thread. And you're seeing a lot of lawsuits come out from for example, the Nightingale situation, where a gentleman ran off with millions of dollars that he had raised within that platform. And so there's a lot of negative news out there, and some of this is not necessarily on the syndicators themselves. And so many syndicators are getting essentially looked at in a bad light because they are working through the current constraints of the market. But DJ, I'm really excited that we have you here, because you play in the realm of family office, and Arthur, you're an expert on this as well. How are family
experts to stretch? Hang on, I dabble in it a little bit, but thank you.
So I think, you talk about this turmoil, and you can continue to go on. I mean, there's like $500 billion on the watch list from debt perspective. There's $200 trillion coming due here over the next 12 to 18 months. And the same thing in hospitality. There's about $28 billion of debt. And not surprised with the crowdfunding, because everything's gone up, right? And so they've never really had to deal with this before. But, you call it turmoil, I call it opportunity. And back in, when we talk about family offices, back in the recession, families didn't invest and come back into the market until things were on the upswing. So they missed a lot of that opportunity to buy at great prices. Well, when COVID hit, they learned from that, and they started wanting to build up dry powder. Now, that never happened like we thought, but they were ready to do it. And that's happening. That's what's happening right now with the families, is building up dry powder, waiting to see what happens and where the opportunities are. And they do have capital calls from sponsors that's come back to them and whatnot. But, there are the majority this time of families that are waiting to take advantage of the turmoil.
Do you think, DJ, that the families that you speak of are primarily building dry powder that have experience in real estate investing? Or is there a segment also that you've seen trying to get into real estate at this low point, so to speak?
You know, when you say experience in real estate, are you talking about a family that created their wealth in real estate?
Yeah, let's just say that. Yeah.
Okay, if you, I'll tell you this, there's 5 different classifications of families when it comes to real estate. You have the families that created their wealth, obviously, and which is what you're talking about. Those families today, they are looking for opportunities. They're probably knee deep and could very well be knee deep like all other sponsors, right? That we're expecting to roll out, do a permanent financing at 4.25, and that's not happening now. And so now they have negative leverage. But they're the operators. So you sort of you would classify them into the sponsors today based upon what's happening. The next level are the Michael Dells of the world, the Bloombergs. They're not going to put out any more than 20 million, but they have hired institutional people that are making those decisions. So they're getting a little bit more granular. The third area of family offices are families that are have their own properties. So they're building up their own real estate properties. They might have a property manager that helps overseas or an asset manager or whatnot. Now you start moving down the road where they're like, okay, let's start taking a look at some of these opportunities. And then you have the next one, number 4, which is the families that they don't have the ability to run those properties internally. So they look to joint venture with other sponsors and investing. They're going through a period right now where they are getting capital calls because they were wanting to go direct. In fact, with our study, continual over the 5 years, 70% wanted to go direct. And then the last ones is the families that have no idea and they don't have the resources to do the research. So they go into funds primarily. And so you're really looking at the families that have their own portfolio and the families that will invest with operators who are really building up that dry powder for the most part as a whole. And then the institutional guys are looking for deep discounts with the big families that they work for.
And DJ, I know that we've been hearing about dry powder for at least 2 years now, from my perspective. And I feel like the wave did not come nearly as soon as many of those people were thinking. So now they have this capital that has not been working. What's their sentiment on that? Do you see that some of them are getting antsy and they're looking to get into opportunities and maybe not looking for so much blood in the streets, or do they think that the opportunity is right around the corner?
You know, it's funny. One of the questions that we asked, and this is going back 5 years, right? 2019, when do you think there's going to be a downturn? And inevitably, you have the majority of people 7 to 9 months, right? They think it's going to be happening in the short term. You know, they're waiting for it. They're looking for it. Unfortunately, as all the deals that I've been seeing happening are where, let's say I'm a sponsor or an operator and I'm having a problem. So I might call you up, Christian. I might say, hey, I'm having an issue here. Do you know of anybody that might want to step in and take this over? It's not even going to the market and being listed, right? Yeah. And I think we're in a situation where there's troubles. The banks don't realize it yet because those payments are being made, but we still have some time to come, and families will just keep sticking it out and waiting to see what happens. But
well,
didn't
mean to interrupt you there, but I would even say that many of these banks do know, but they're extending and pretending because they don't want to deal with this issue either. They don't want this issue to come too far to light too quickly. And so I think that many of the banks are working with these syndicators from the conversations that we're having in the market. And so does it ever get to the point, or do these guys extend and pretend long enough that interest rates come back a little closer into line where they can make the transactions work, or they gain enough equity?
Well, that's the crystal ball, right? Are they going to be able to make it through to that time and just get through it? And, the banks do have limitations on what they can have on their balance sheet and whatnot. So they are watching it closer than they had, back in the recession. But that's the question. I mean, we are in a electoral year, right? So if Trump comes back, could make a big difference. Biden staying in could make a big difference. Interest rates, I mean, they've been pretty hovering for the most part and don't seem to be going anywhere. And so as long as they have staying power, and the banks will work with them, then they can get through it. It just depends on how much they have or how sideways they are, right?
Yeah.
What's
DJ,
the
what do you
date?
think about, let's talk in just multifamily, for instance, we are finding this crunch financially. However, there's still so much housing needed. And we know that usually you have to have that surplus in order to have that economical downturn. What do you
That's my
see
thoughts.
happening since we've got
We,
two different things going on?
yeah, well, so we haven't done any multifamily in the last 5 years. It
Okay.
just didn't make any sense. Now we're extremely bullish, and that's because what I had mentioned before is that you had people, and you look at pro formas, you look at what the returns they're projecting, and it's based upon interest only at 3.5%. Then they're going to refinance at 4.25 because they bought it a 5 cap and plan to sell it a 4 cap. Well, now you bought it a 5 cap, which you still did, but now you have to refinance at 6.75. You have negative leverage, right? So, but with that, it's going to create opportunity. But like you said, the demand is still there. There's a significant amount of demand for multifamily. So if everything plays out, this is the time when the real money is made, because you're able to start buying great assets at a discount because of some distress that happens in an asset class property type where there's a huge demand going forward 5, 6, 7 years, right? That's sort of like the perfect storm that's coming together. But that demand is going to continue, and there won't be development either. So it's going to go to a point where you'll rotate or you'll switch on some of the people that own the properties today. Maybe Arthur comes in and buys it because they were having some trouble. Well, he's not building right now, so there's going to be a shortage in as well, which will drive the demand again.
Do you see those properties coming to market?
Right
The
now,
distressed multifamilies?
right now, as I said, it's been all word of mouth that I've seen. It's just people calling to say, who do you know, or not listing it, not putting it on the market. There was an article last summer in the Wall Street Journal about a guy had $500 million of properties in Texas, and he had to give back $350 million worth of that. And he was very well upside down. And so it goes back to what Christian said, which is, can they wait out the storm, basically? And I think we're getting to the point where over the next, couple quarters, we're going to really start seeing if it's starting to come to the surface or not, because I don't see change in interest rates. And at some point in time, if you can't pay the bills, you got to do capital calls, which is happening. But if you don't negotiate with the lender, so we still have to feel it out a little bit. But I think it's just slowly brewing. But as I said before, there's $500 billion on the watch list right now.
And you have the feds that are now tightening the screws on these regional banks. And the regional banks, from what I read in a recent article, have 80% of this debt of commercial real estate. And so you're talking about, the same banks that have created so much unrest within many people's minds are the ones that are holding this debt. And so they have stricter guidelines to even be able to offer new debt. So I think that's where things start getting really dicey.
Well, I can tell you a story. So we have a partner down in Houston for it's a workforce housing, and it's a combination of 400 square foot modular homes in a mobile home park environment, right? The demand is huge down in Texas, and they had some debt lined up from regional banks, just like you were saying. And then when everything started to happen, they went back to the market, and they went through 230 lenders, could not find one that made sense at all. So now they're going to be building with cash on these. And it's the regional banks that they had all these term sheets and everything else, just like you said. And so when they've, closed that up, that's causing a problem for sure.
Is private credit active in this area? Because we see so many companies getting into the private credit business.
Yeah, it is. I mean, and that's sort of like the last hurrah, right? It's like, okay, I don't want to give it back, so I'm going to take something at a 10, 11 interest rate.
Yeah,
Once again, I
usury.
hope I can wait it out, right?
Yeah.
Maybe even 12 plus. But that's where you see this private credit, like you're talking about, also mezzanine, right? Same thing. And so that is that's coming to fruition for sure. And it's an area where people they're paying that. There's people that are paying those rates. And I think it's just because I'd rather give it a try instead of give it back.
Yeah, we've seen, in fact, we had Sebastian on from the Lionheart, which is the Fisher Brothers private credit division. You may know them. We had him on the program, if you guys remember, a few weeks ago, and they're heavily into the mezzanine and have experienced, they've got a big pot of money and they're lending large checks, and so it's not for, the guy that needs $30 million for his multifamily housing. It's, significantly bigger checks, but they've experienced in a, reasonably long period of time, 24 months, no defaults, and everybody's paying them back. So it's interesting to see that maybe private credit is working. So I set you up a little bit because I kind of knew the answer to the question.
Yes and no. I'll tell you, the bank is never going to think you have. Let's say you lost your job, and you don't have money you have no income, and you can't find a job, but you had savings, so you're paying your mortgage. The bank has no idea as long as those payments are being made. Right.
Yeah.
And so they're doing all this business, but where's that money coming from and how long can they hang on? That's the question, right? And that we don't know. I mean, hopefully they know, but I think it goes back to the same thing we've been talking about, which is how long can I maintain this before I have to give it back and walk away? And I'll do anything I have to do that.
Yeah. How much of this election year, delay, like the Democrats and the Republicans don't want disruption in the financial markets. They don't want a crisis. They don't want interest rates to go to the roof. They want the stock market to stay frothy. I'm not being partisan at all. I'm just saying they both want the stability coming into the election, right? Is the manipulation of that apparent to you, or is it free market making it happen?
I think Trump doesn't want us. Well, he'll play it any way he wants to, but if it's not doing well, he's definitely going to play that card, right, and bring it back. He even said in the paper the other day that he wanted to see about being in control of the Fed, which is a whole nother conversation, because if that happens, then now that's just a whole nother story, right? But in the election year, they're going to do whatever they can to get reelected at the end of the day. But we're going to know in September. And what I was saying before is I don't think you're going to see a lot of change in the interest rates. I think they're going to pretty well hold tight. There's not much they can do in 6 months because there's a lag. What they do today, you're not going to see anything for 6-9 months, right?
At least,
so
yeah.
they've done what they can. Is the way I see it.
Yeah.
DJ, with some of these family offices that you had mentioned where they end up just going in and partnering with the syndicator essentially because they don't want to do the operations, are they finding opportunities right now in pref equity where they can step in and take a large chunk of the GP stake for injecting capital into deals that have enough equity?
It depends on who the family is. I mean, there are some families that said, let's load up and maybe let's try to syndicate some of that money ourselves or bring in other families to take it out to the market. That's happened. On the other side, you have You have families that are very skittish because they've had some capital calls and they just don't want to do anything, right? It depends on where they are in their portfolio at the time. But there's definitely families started moving into that type of finance and providing that about 3 years ago, believe it or not. So they started switching from equity into the debt. A lot of them were going into the first position, which is the best place to be, right? Because then you can have those controls and everything. And so a lot of them were going into that first position, and now it's a matter of if they're comfortable enough with it, then yeah, they're looking to get the higher returns.
Nice. DJ, you told us earlier that you started your family office real estate institute kind of by mistake, and I want to hear a little bit about how that came into play.
Sure. So and you'll understand as I go through this. So when I fell into the family office space, the patriarch that I ended up working for, when he died, all his money was going to his foundation. So he was talking about putting a fund together at the time. And they asked me, do you think we should go institutional or should you go family office? Well, I knew everybody on their board. I had relationships with them on the institutional side. And I only knew 2 family offices, but he was really a family. I mean, it was all his own money that was going into everything. And I said, well, we should go to the family office side. And so, well, I got to get out there. I got to start meeting people I only know too. And so I put up a one-page website that was with some education talking about the cycle. And then I wrote a book on family office real estate investing. And then I started going to conferences, and then I started doing podcasts. And then I had this brilliant idea to start the Family Office Real Estate Magazine, which is still in existence, a quarterly publication. And then from there, started the study after that, calling families that I knew, because after that was a couple of years now. And so I knew the families where I could call them to make sure that they're legitimate information that I was able to get. Put together a consortium event, which was in Breckenridge right before COVID. And, we had about 22 families there. We had about maybe 8 sponsors. So it was small, but it was greatly, people loved to go to it. And for me, it was great because we were able to screen various investment opportunities ourselves. And there, a professor from the University of Denver asked me if I wanted to start the Family Office Real Estate Institute at the university. And that's how, this is how this whole thing started. And then I'm like, hey, let's do executive education. So then we started executive education classes, and it's just continued to get to this point where we're at now. And I had no idea. I was just trying to, create a name for myself and being aware. What I say is do everything that you're supposed to do that you don't do, and even writing the thank you notes and stuff like that. And so that's what I've done. And this is where we're at today. And now we just had our first conference last year, and moving forward.
How much of what you do is targeted to, the second and third generation family members to keep them is it that type of training, or is it training for what is it?
So that's a good question. We've actually I've been in meetings over the last couple of days for us to really zone in on our focus. And so I can tell you today that exact focus is our definition of a family office is worth $250 million or more. So it's family members, family offices, family office executives that are targeted, or families that have a business that they might be selling, or they have a big exit that's coming up, where the real estate, I believe 100% that's the solution to maintain a legacy and wealth. Yep. And I don't know if you guys have heard the statistics before, but 70% of families lose their wealth by the second generation, 90% by the third. And real estate's a hard asset. It's not liquid. and it has tax benefits and everything else. So I am, you know, an evangelicist when it comes to real estate and families and maintaining that legacy and wealth. And so everything that we're targeting is that education component. So maybe you take over a real estate portfolio, or maybe you don't have hardly any real estate in the portfolio and you want to know how do I identify it? How do I underwrite it? How do I look for a good sponsor, right? What markets do I go into? And, you know, so that's the type of information that we look at and we provide. In fact, in our first exec ed program a couple of years ago, we had 3 billionaire families represented in there. And we were going over portfolio construction and where are we in the market cycle, and you know, where are the opportunities and how do you underwrite and stuff like that. So it's really targeted toward those families that want to increase their understanding and knowledge with real estate.
So
Right.
you talked about the barrier as you identified the threshold. How does one get involved if they meet that threshold, and what can they expect?
Well, right now we have we will end up putting together a membership, which will be coming up in the probably going into next year. So at our website, which is Family Office, well, FORE, which stands for Family Office Real Estate Institute, is really where the information is. And you can sign up to be kept in touch. That's really where it starts. So if you want to know when the next exec ed class is going to be held, or the conference you want to take a look at, or go to an investment forum, or even just listen, you know, a podcast or read a white paper, things that, you know, we are focused on going into the second part of the year is increasing the awareness of the Institute. And it's been pretty cool because we don't just talk about real estate, but we'll also talk about things like governance, and we'll talk about family councils and investment policy statements. And, you know, we do that for two reasons. One is the sponsors are always looking as let's just get the check, and they think it's going to be easy and they're just going to write a check. Well, they have the family has a lot of stuff going on. We've all had issues with our family at some point in time, brother, sister, aunt, uncle, parents, whatever. Okay, now add on a ton of zeros to that, and that becomes that much bigger of an issue. So we include some of that information, and there's been some families that have actually put in governance in place, not from me, but people that are specialists, which they've set their families up for multiple generations. It's been pretty cool, you know, and that's a side part that I never realized that could really come out of it, but it's been great, you know. But it's there's a lot of nuances with families, and there's a saying that, you know, you met one family office, you've met one family office, and that's pretty true.
Pretty true, yeah. Well, we'll make sure.
Find yourself. Oh, sorry. Go ahead, Arthur.
No, I wouldn't even think about it. Julie, go ahead.
You're so polite. Thank you. Do you find, is there something you constantly find yourself telling family offices about real estate and wondering, why don't people know this? Or, you know, are there things that, what are the missing blocks that you're constantly having to instruct on?
Due diligence, underwriting is probably number one. And, you know, I've been sent information to look at, and they sent me the deck. And that was it. And I'm like, okay, I need to see the PPM. I need to see the Excel, the financial model. What are the assumptions, all this stuff. However, first, it doesn't matter how good the deal is if the sponsor can't implement. And so you really need to start with the sponsor, right? And so that's the number one thing. But when you think about it, and I made the same mistake too, you know, when I started in the space, I'm like, okay, well, I'm just going to go straight to it and talk very high, you know, very sophisticated and everything else about all these details with the family. They're worth hundreds of millions of dollars, billions of dollars. They're smart, they're intelligent, they're, you know, they're successful, all this, they know this stuff. The reality is they spent the, huh?
They
What?
didn't know. Oh.
The truth is they spent the last 40 years in chemicals or tires. And so if you ask them about that, they are going to whip it off for you right away. But they don't understand private equity, real estate, hedge funds, venture capital. And if you think about it, people spend their whole life not just in venture capital, but middle market venture capital, and not just middle market, but healthcare, right? And that's their whole career. So there's an assumption that they understand a lot more than what they really do. And that's the biggest discrepancy, but it comes back to making a good decision on what to look for. But they usually will go with 4 to 6, maybe sponsors, and they'll start small and then they'll get a bigger check. But when you're in and when you have that relationship, they're not going anywhere. And they'll tell other families as well.
That's
Well, I'm
right.
glad you led with the sponsor first. This is something that we really advocate for, and anybody that wants to be featured on our platform has to go through our sponsor approval process. So at least we have that minimum check. Are we dealing with a good player? And unfortunately, all too often, investments, and especially in real estate, are looked at as just, the numbers and the asset, and everything is the people, right?
Yeah, it's and I Julie, you brought up multifamily before. Look, if you haven't made money since 2012, you shouldn't even be living in an apartment, let alone own one, because everything's gone up and you've made money. Now's the time of, okay, how are you doing? I mean, one of the questions that I'll ask is, were you around the recession? And if they were, I'll ask them, well, how many properties did you get back? Because I wanted to know what they did. If they said none, okay, that's great. If they say they did, okay, fine. What did you learn from that? And what are you going to do different this time? Or how are you running the business different, right? And I think those questions are relevant today, is that how are you handling your portfolio today after interest rates have gone up? Have you had to do capital calls? Have you not? What have you done about the leverage and all the, so there's a lot of things that hopefully they'll learn from that'll make them better operators, sponsors, which will then help the investments. But yeah, you really have to dig in.
Yeah, one of the things that I want to make sure we communicate to the Family Office Insights community is what you are talking about with the Institute. And it's for 2 reasons. One, we don't do in Family Office Insights that sort of thing at all. We'd never professed we did. And, we're very narrowly focused on deal flow. But the reason why I want to make sure people are aware of it in the context as how you describe it is because we get calls about it all the time. And I think it's partly the function of our name, Family Office Insights. Well, we're not giving family governance insights, how to keep your kids off of drugs, how to do, family meetings. We're not doing that, but we get calls about it regularly. And so it's been a strategic choice for us not to do that. And it's also something we don't have the bandwidth to do. And I'm not sure we do well at it at all. So I'm super happy to hear that you're doing that. And I think the community of Family Office Insights, which is mostly focused on investing things, we're not broker dealers and we don't participate in that. We just bring deal flow to the table. But I think they'd appreciate hearing about that. So I'm super glad that we get the talk.
I'll be honest with you. I know enough to be dangerous, but I also know what I don't know. So there's a couple people that are the best in the space in family offices that handle the governance and that handles that stuff. And I point them in that direction because I know they're going to be taken care of.
Yeah,
but
that's
it's
super valuable.
Yeah, well, it's something too, though, that comes up because, there's issue. Everybody thinks that they're in good shape and they're structured properly. And, today everybody's a family office and there's a lot more to that. And especially depending on how big you are. So, but bringing it up, I think also puts you in a different space of where they're like, okay, they're not just here to, or DJ's not just here to sell a product or something like that. I mean, he's letting me know of something that I didn't know. And that's what I was saying before, where some people got governance put in place, not by me, by somebody I referred them to. But it's pretty cool because, you know, they rant and rave about this person, but it was thanks to me. So I think it's, you know, and I'm happy to introduce you to those people as well and whatnot, because it is very important.
Yeah. It's proved to be very important for a lot of families. And we all know, for, you know, the example that's regularly used is, you know, the $3 billion family office that has 3 asset classes doing all their tracking of investment and performance on a spreadsheet in the back room, you know, with the Doris that's been there 34 years, right? That's still happening.
It does.
Yeah.
It does. That's probably one of the biggest issues that families have, which is they have all these investments because they will do a lot of private investments and they're everywhere. You don't have a consolidated statement like you get at JP Morgan. You've got this here, that here, this here. So there are firms that have come to the forefront to say, hey, we can help you with all of that. Talking to my friend Tom Handler, who's one of the top family office attorneys and a good friend, just earlier today, and he was talking about one of his families that had 127 LLCs.
Entities, yeah. Yeah.
That's a lot.
We've seen a lot of that. Yeah.
Can't imagine being first generation and I'm passionate about something and I have the knowledge and I've built success, and then I pass that on to second generation who might not be as savvy or as excited about it and go, and here's your Excel spreadsheet. Like, that's kind of terrifying. So I'm glad you're instilling.
And Doris is dead.
Yeah. What happens if, right? Yeah, I'll tell you a funny story. I'm down in West Palm Beach. This is years ago. And I was eating lunch. I got there late or something. And then this girl comes in and she's got her exercise outfit on, right? And she's younger, probably some mid-20s or whatnot. And I said, so what are you doing here? And she goes, well, family has a lot of money and I think it's about time I start to understand, you know, what's going on. And she's a Pilates instructor, which is fine. But, you know, a lot of kids don't even want to deal with any of that, right? Or maybe they haven't been introduced to it from the family, and you give them that spreadsheet and it's like, you know, it's foreign language. They're not going to know what all that stuff is. And so, yeah, I mean, but it happens more than you think.
Well, this is one of the reasons I really advocate for passive investing, private market passive investing. Is for a long time, even for myself, I had this idea that I wanted to leave a legacy. And so I thought about all the properties that I wanted to own. And then I watched enough of my peers, even though they were much older than me, I considered them peers because we were, you know, doing business together, and they passed it on to the next generation. The next generation wanted nothing to do with that real estate, and they were selling it at a discount, or they were letting it go into disrepair. And so I think that you have to really consider that. I read a really good book recently. I think it's called Entrusted. So good book around this whole concept of figuring out who in the family is suited enough to take on these investments. And if they're not, should you just be passive so that you can leave something that they can pursue their own passions with the wealth that's transferred? It's
not just the knowledge, and do they want to do it, right? Do they even want to deal with it and understand it? And of course, they're going to have their different ideas. There's definitely a difference between the younger gen, fourth gens that are in their 20s, 30s, and how they view things than the patriarchs that are in their 70s. I mean, there's a significant difference. And so back to what you're saying, I'm going to sell that so I can invest in this over here. And then I'm going to make $1 billion myself anyway, because I'm going to put it all into this tech company that's a startup, right? And that happens all the time. But passive investing, like you said, it's no different than when you are invested in a mutual fund. You're relying on that manager to help make good decisions for you. And there's a lot more to it than what, especially in real estate. I mean, that's probably one of my biggest things is that when people don't really understand, they don't want to pay fees, but yet they don't understand really what that company's dealing with. You know, they could have a zoning issue, or they rip down a wall and now the whole thing has a big problem, or they're waiting for the city on something. I mean, there's a lot of stuff that deals with it, and it's much better to get checks in the mail than it is to,
Deal with that for sure. Yeah.
yeah,
Yeah.
yeah. And the
You say that-
secondary market with what you're saying is actually, it's great because liquidity is an issue. Obviously with real estate, it's a hard asset. That's a benefit, right? But there are times you do want that secondary component. And if it's not available, especially the private real estate, what do?
Do you see much of that now?
Of what? Looking for liquidity?
Yes.
I do. I see some of it. I do see some of that from various families, but the good thing about families is that it's patient capital. So typically they'll take a longer view and they'll be like, I can wait it out. I don't have to sell. I don't have to go in. And so it just depends. But then again, the patriarch could die and I've got to get out of this thing. So it just depends where they are in that, in that time being, what they're dealing with. Right. And if there's nowhere to go and you're stuck with your shares, you have a problem. That's why if you have a secondary option, it makes a lot of sense.
Yeah, we believe that it's a service that's widely needed. I'm curious about your study. What is maybe an insight that you didn't expect to figure out when you started that study that really sticks on your mind?
The number one thing, and it's been 5 years in a row, families, very wealthy, care about taxes. I think everybody would agree. I think families would agree on that too. Yet 80%, and it's between 79, 81%, 80% 5 years in a row didn't do a 1031 exchange.
Mm.
It's one of the best tax vehicles available, and it's not being utilized. That's the number one thing, I would say. And then the next thing is would be opportunity zones. I mean, a very small portion of families invest into opportunity zones. There are reasons for that, but those are probably two of the biggest things that's our tax related that real estate has. And then you get into education is another one that's pretty continual and always wanting to go direct.
There was a trend, DJ, starting 10 years ago, let's just say, where direct was what everybody was talking about because of the fee structures. And it's just my experience, and I'm wondering what yours was, is that people would talk about going direct, get to the 11th hour, chicken out because they really realized that they didn't know what was what they were in for to manage something direct, especially if they hadn't been, for example, in the real estate business or some other type of business that they felt they didn't want to pay fees on for private equity or otherwise. And then they chickened out because they came to the realization that there was a lot more to it and that the 2 and 20 really was a bargain. And I'm not saying that across the board, but did you see that sort of undulation in that trend over the last 10 years?
It's, as I said, 70% of families have wanted to go directly into the deals. Would complain about funds because of their fees, just like you had mentioned. But the average allocation pretty consistently has been around 25% of a family's portfolio into real estate. And that's where they've really seen their returns. And of course, their friends are seeing the returns because everything's been going up.
Right.
So, but with that being said, and a friend of mine brought this up maybe 8 years ago, he's like, look, when there's a downturn, they're going to realize it's not that easy. And they're going to come to the realization that maybe we should put it into a diversified portfolio. And I think that's where we're at right now. And I actually ran an analysis last week, a couple of weeks ago, of if you invested directly into a deal and you sold it 6 years later, and let's say you doubled it, right? So you doubled in that period, and then you paid your taxes and you invested in another direct deal, and you did that over 36 years compared to, another alternative, and there was no comparison. There was just no comparison from that. And, so and that's part of the education process, is really explaining. In fact, one of the things that would probably be fun to do at one of the executive education classes is to say, okay, you're a property owner, and you give them a case study, and they have to start dealing with all of the stuff like, this just happened. What are you going to do?
Townships just had a meeting and decided that your zoning just changed,
Yeah.
right?
What are you going to do? In fact, that's a hell of an idea, actually, because that's really what's needed to be understood. And people don't understand. They think, I'll just buy that property. It's going to go up. I'm going to make money. It doesn't work like that,
Yeah. Why do you think that in your study that the 1031s weren't adopted? Was it lack of like-kind exchanges, or the lack of understanding the complexities of that?
I think it's just understanding them in general.
Yeah.
I think it's a pure education and understanding. You do have families that will hold on to assets. If they're a legacy asset, obviously you can't include that. But
Right.
The same amount didn't even know what a DST was. And so it's an educational component to say, hey, here's something that can be done. And so but once again, you're back into being active. You have to be active to be able to take it through that process, identify the deal and all this other stuff. But it comes back to education. It's the same thing with the opportunity zones. Just didn't understand it. And the majority of families still don't understand it.
Are many of them doing cost segregation?
So I sent out an email, this is a number of years back, and I sent it out about cost seg. My phone rang off the hook, and emails asking about cost seg. What is this? What are you talking about? So the short answer is no. It's not, all of that is not truly really understood. I mean, when you break everything down, between all the depreciation and interest rate deduction, and you can defer your gains, and you have cost segregation, and there's a lot of pluses to it, and that gets overlooked.
Well, we're here at the top of the hour. Is there any final insights that you want to give the audience, and specifically anybody in that family office world?
The biggest thing I would say is that, and we brought this up before, but whether it's an advisor or it's a sponsor, an operator, you're best to partner with people that know what they're doing, and they've sort of paved the way, and they've been through those issues. That's your best action to take. And, the fees, you got to get paid to do what you're doing. But when you had your business, you were charging fees too, right, for what you were doing. And you hired the best people, and you need to, it's the majority of families, believe it or not, I really believe they forgot how to do business, because they, like I said, they'd have quarterly meetings. They'd hire the best people, they'd focus on expenses, and they charge, make sure they had profits and stuff like this. But yet they get all this money and they forget it all. They don't want to pay to hire the best people. They don't want to, pay this fee or that fee. And so, look at it like a business, and, obviously be smart about it, but take advantage of resources like what you guys have and what other people that are seasoned have as well.
That's good advice. What is the best way, just so people can have this on the recording, for them to get in touch with you?
Well, they can reach me through my personal website, which is just djvankeuren.com. They can go to the FORE Institute, FORE.institute. or Evergreen Property Partners. I mean, there's ways to get in touch with me through there, and LinkedIn, of course, as well. And we have a LinkedIn newsletter. Actually, we have about 33,000 people now, and we'll put out information, and that's been great. And so one of those ways is probably the best.